Before we dive in, it is critical to understand that this presentation is for informational and educational purposes only. I am not a licensed financial advisor, mortgage lender, or real estate agent. The information provided in this video does not constitute financial, legal, or real estate advice. The mortgage landscape changes constantly, and programs can vary by state, lender, and your individual financial situation. Always consult with qualified professionals before making any major financial decisions. Your journey to homeownership is unique, and you deserve personalized advice from experts who can review your specific circumstances. You've done everything you were supposed to do. You work hard. You pay your bills on time every single month. In fact, you're probably paying a landlord an amount of money that could easily be a mortgage payment, and you've never missed a payment. You've tried to save, tucking away a few $100s here and there, watching your savings account grow at a snail's pace. But then you look at the housing market. You see the prices, you do the math, and you land on that one soul-crushing number, the 20% down payment. For a modest $400,000 home, that's $80,000. $80,000 in cash. For most people, that number isn't a goal. It's a brick wall. It feels like a gatekeeper, designed specifically to keep you out of the club of homeownership, forcing you to keep renting and building someone else's equity, someone else's dream. But what if I told you that the 20% down payment is one of the biggest and most persistent myths in the entire American real estate market? What if I told you that for millions of Americans, that $80,000 brick wall is completely imaginary? And what if I told you there are proven government-backed pathways that allow you to walk into a new home keys in hand, with absolutely $0 down? Not 3%, not 5%. Zero. It sounds like a late-night infomercial, I know. Sounds too good to be true. But it is not. This is the reality that thousands of homebuyers are using every single month to achieve the American dream. And the big banks and some real estate agents just aren't shouting about it from the rooftops. In this video, we are going to tear down that brick wall piece by piece. We are going to expose the myth of the 20% down payment and give you a crystal clear roadmap to the legitimate, powerful mortgage options that require no down payment at all. This isn't about finding some shady loophole or a risky, exotic loan. This is about understanding the incredible tools that are already in place, specifically designed to help people just like you buy a home. By the time you finish watching this, you will not only believe that a zero-down mortgage is possible, you will know exactly which programs exist, how they work, who qualifies, and the precise steps you need to take to see if one of them is right for you. So where did this 20% rule even come from? Why is it hammered into our heads from the moment we even think about buying a house? It's simple, really. It's all about risk. Decades ago, after the Great Depression, lenders wanted to make sure that borrowers had some skin in the game. A 20% down payment did two things. First, it showed that the borrower was financially disciplined enough to save a large sum of money. Second, and more importantly, it created an instant equity cushion for the bank. If you immediately owned 20% of your home's value, you were far less likely to just walk away if times got tough. And if you did default, the bank had a 20% buffer before they started losing money on a foreclosure. It was a simple, effective way for them to minimize their risk. The other major reason this number became so popular was something called private mortgage insurance, or PMI. If you put down less than 20%, lenders see you as a higher risk. To offset that risk, they require you to pay an extra insurance premium every month, PMI. This insurance doesn't protect you. It protects the lender in case you default. So the rule became, put down 20% to avoid paying PMI. It was presented as the smart, financially savvy thing to do. And for those who can afford it, it absolutely is. Avoiding PMI saves you money. But over time, this advice morphed from a good way to save money into the only way to buy a home. And that's where the myth took hold and locked millions of people out of the market. The financial world today is completely different than it was 50 years ago. Lenders and the government have created new, sophisticated ways to manage risk that don't rely solely on a massive cash down payment from the buyer. They realize that a person's ability to pay their bills month after month, their credit history and their debt-to-income ratio, is often a much better indicator of a reliable borrower than a huge pile of inherited cash. This realization led to the creation of incredible government-backed loan programs designed to open the doors of homeownership to a wider range of Americans. And the two most powerful zero-down payment programs in the entire country are the VA loan, backed by the U.S. Department of Veterans Affairs, and the USDA loan, backed by the U.S. Department of Agriculture. Let's be clear, these aren't handouts. These are hand-ups. The government isn't giving you a house. What they are doing is providing a guarantee to the lender. They are essentially telling the bank, hey, we've vetted this person. We believe in them. If you lend them the money to buy a home with zero down payment, and something goes horribly wrong and they default, we will cover your losses. This government guarantee is like the ultimate cosigner. It completely removes the lender's risk of not having that 20% equity cushion, which in turn allows them to lend you 100% of the home's purchase price. That is the secret. That is the mechanism that makes a zero-down mortgage possible. It's a partnership between you, the lender, and the US government. Now you're probably thinking, okay, this sounds great, but what's the catch? There's always a catch. And you're right to be skeptical. These programs aren't for everyone. They have very specific eligibility requirements. You can't just walk in off the street and get one. The VA loan, for example, is an earned benefit exclusively for our nation's service members, veterans, and eligible surviving spouses. It is, without a doubt, the best mortgage product in America, and if you have any connection to the military, you absolutely need to understand how it works. The USDA loan, on the other hand, is not about your profession, it's about location. It's designed to promote homeownership and development in rural and suburban areas. And you would be absolutely shocked to learn what the government considers rural. Many small towns and suburbs just outside of major metropolitan cities qualify, areas you would never think of as rural. So the catch isn't some hidden fee or a bait-and-switch. The catch is simply that you have to fit into one of the specific boxes these programs were designed for. And that's what we're going to explore in detail. We're going to break down these requirements, not in confusing banker speak, but in plain, simple English. We'll look at who qualifies for a VA loan and the documents you need. We'll show you the exact maps and tools to see if the home you're dreaming of is in a USDA-eligible area. We will also talk about other low down payment options, like FHA loans which only require 3.5% down, and conventional loans that can go as low as 3% down. While not zero, these are drastically more achievable than the 20% myth. This is your masterclass in making homeownership a reality without a six-figure savings account. The information we are about to cover has the potential to change your financial future and your family's future for generations. It's time to stop letting a myth hold you back. Let's start by diving deep into the single most powerful mortgage option on the planet, the VA home loan. Even if you don't think you're eligible, stick around. You might be surprised by who actually qualifies, and understanding how it works provides a perfect foundation for understanding all other government-backed loans. So let's start with the origin story. The year is 1944. Millions of American GIs are fighting overseas in World War II. Back home, Congress is already thinking about what happens when they return. They pass a landmark piece of legislation, the Servicemen's Readjustment Act, better known as the GI Bill. It was a promise that the nation would help its returning heroes readjust to civilian life with access to education, unemployment benefits, and most importantly for our conversation, affordable homeownership. The VA loan wasn't just a financial product. It was a thank you. It was a tool designed to build futures and rebuild a nation. And the genius behind it wasn't that the government started handing out massive bags of cash. The real magic is in a single word: guarantee. See, the Department of Veterans Affairs doesn't actually lend you the money to buy a house. A regular bank or mortgage lender like Chase or Rocket Mortgage does that. The VA's role is to act like the most powerful, most trustworthy cosigner in the entire world. They go to the bank and say, hey, lend this veteran the money to buy a home. If for some reason they can't make their payments and the loan goes into foreclosure, which is rare, we've got your back. We will cover a significant portion of your loss. Think about it from the bank's perspective. Their biggest fear is losing money. Suddenly, the VA has stepped in and removed a huge chunk of that risk. The loan is now a much safer bet. And when a loan is safer for the bank, they can offer incredible terms to the borrower. This single concept of the VA guarantee is the key that unlocks the three almost unbelievable benefits of the program. The first and the most famous is a true zero down payment. Not 3.5% down, not 5% down, zero. You can finance 100% of the home's purchase price. This is the single biggest barrier to homeownership for most people, and the VA loan simply erases it. While your friends are scraping together $20,000, $30,000, or $50,000 for a down payment on a modest home, a qualified veteran can walk in the door with literally nothing down. This benefit alone has changed the financial trajectory for millions of families. The second massive benefit is the complete elimination of private mortgage insurance, or PMI. If you get a conventional loan and put down less than 20%, the lender forces you to pay for an insurance policy. But this insurance doesn't protect you, protects them. You're paying a monthly fee, often hundreds of dollars, just to cover the lender's risk. It's like being forced to buy your boss a birthday present every single month. With a VA loan, that whole concept is gone. The VA guarantee already covers the lender's risk, so there's no need for PMI. On a $400,000 home, skipping PMI could save you $200 to $300 every single month. That's over $3,000 a year that stays in your checking account, not the lender's. Over 5 years, that's $15,000. The savings are staggering. And the third major benefit is that VA loans typically have some of the lowest interest rates on the market. Again, it all comes back to that guarantee. Because the loan is so safe for the lender, they're competing for your business. This competition drives down rates. A lower interest rate, even by 0.25%, can save you tens of thousands of dollars over the life of a 30-year mortgage. So zero down, no PMI, and lower interest rates. Sounds too good to be true. And you know the old saying. So what's the catch? Well, there is a cost, but it's a very reasonable and purposeful one. It's called the VA funding fee. This is a one-time fee paid directly to the Department of Veterans Affairs to help keep the loan program running for future generations of service members, with no additional burden on taxpayers. It's veterans helping veterans. The amount of the fee varies. For a first-time user with zero down, it's typically 2.15% of the loan amount. For a $300,000 loan, that's $6,450. Now, before you panic and think you need to write a check for $6,000, you don't. For the vast majority of borrowers, this fee is simply rolled into the total loan amount and paid off over the 30 years. It adds a small amount to your monthly payment, a fraction of what you'd pay in PMI. And here's a critical piece of information. Not everyone has to pay it. If you are a veteran receiving VA disability compensation, or a surviving spouse of a veteran who died in service, you are typically exempt from the VA funding fee entirely. This makes the best mortgage on the planet even better. This brings us to the most important question. Who actually qualifies? This is where that surprise I mentioned comes in. Of course, we have our active duty service members and honorably discharged veterans. The general rule of thumb is you need 24 continuous months of service if you enlisted after 1980, or 90 days of active duty during wartime, or 181 days during peacetime. But the eligibility is much broader than just that. Are you a member of the National Guard or the Reserves? Many believe they aren't eligible, but after 6 years of honorable service, you absolutely earn this benefit. This is a game changer for so many part-time service members who are pillars of our communities. And the circle of eligibility extends even further, into a place of profound honor and respect. Certain surviving spouses of service members are also eligible. If a brave service member died in the line of duty or from a service-related disability, their surviving spouse may inherit this powerful home loan benefit. It's a small way the nation continues to honor their family's ultimate sacrifice. So if you are a surviving spouse or know one, please look into this. The list even includes cadets at the U.S. Military, Air Force or Coast Guard Academy, midshipmen at the Naval Academy, and officers of the National Oceanic and Atmospheric Administration. The point is, don't ever assume you don't qualify. The only way to know for sure is to get your Certificate of Eligibility, or COE. This sounds like a complicated, bureaucratic document, but it's not. The COE is simply the VA's official proof that you meet the minimum service requirements to be eligible for the loan. And you don't have to navigate some clunky government website to get it. Any good mortgage lender who specializes in VA loans can typically pull your COE for you online in a matter of minutes. It's the very first step, and it's easier than ever. Now, even with all these incredible benefits, some myths about the VA loan persist, and they can scare people away from using the benefit they earned. Let's bust them right now. Myth number 1. Sellers hate VA offers because the process is slow and full of red tape. This might have been true in the 1980s, but today it's completely false. With modern technology, a VA loan can close just as quickly as a conventional loan. Furthermore, the appraisal process, while thorough, is designed to protect the veteran, ensuring the house is safe, sound, and worth the price. A pre-approved buyer with a VA loan is one of the strongest buyers in the market. Why? Because that government guarantee means the financing is rock solid. Myth number 2. You can only use your VA loan benefit once. This is one of the biggest and most damaging misconceptions. You can absolutely use your benefit multiple times. When you sell the home you bought with a VA loan and pay it off, your full entitlement is restored, ready to be used again on your next home. You can even have 2 VA loans at once in certain situations, like a permanent change of station for an active duty service member. Your benefit doesn't expire. The VA loan is, without a doubt, a financial superpower. It's a testament to a promise made nearly a century ago. A promise that continues to empower those who have served our country to achieve the American dream of homeownership. So, the VA loan is the undisputed champion for those who qualify. But what about everyone else? What if you're a teacher, a firefighter, a software engineer, or a first-time buyer who hasn't served in the military? Is the dream of a zero-down home dead for you? Absolutely not. In fact, there's a little-known program from the U.S. Department of Agriculture that has almost nothing to do with farming and has helped millions of Americans in small towns and suburbs buy a home with, you guessed it, $0 down. And its eligibility map is going to shock you. This program is called the USDA Rural Development Guaranteed Housing Loan Program. And I know what you're thinking. You just heard 3 words that made you want to click away. USDA, rural, and guaranteed. It sounds like a government program for farmers to buy a silo in the middle of a cornfield. But that is the single biggest, most costly misconception in American real estate. This program isn't about agriculture. It's about population density. The USDA's goal is to encourage people to live in less crowded parts of the country. But their definition of less crowded is where the magic happens. We're not just talking about towns with 1 stoplight and a general store. We are talking about huge swaths of suburban America. We're talking about towns just outside of major metropolitan hubs. Places with great schools, Target, and a Chipotle. Go to the USDA eligibility map right now, pause this video and do it, I'll wait. Type in the address of a suburb you thought was completely mainstream, maybe 45 minutes outside of Dallas, or an hour from Atlanta, or a community just beyond the sprawl of Phoenix. You will be absolutely floored by what qualifies. Millions of Americans are living in USDA-eligible zones right now and have absolutely no idea. They think they need 20% down to buy the house right next door to one that someone else bought with 0 down, all thanks to this loan. So let's break down exactly what this is and who it's for. The USDA loan is a mortgage offered by private lenders, just like a normal loan from your local bank or credit union, but it's guaranteed by the U.S. Department of Agriculture. That guarantee is everything. It's a promise to the lender that if you, the borrower, default on the loan, the government will cover a portion of their loss. This dramatically reduces the bank's risk. And when a bank's risk goes down, the benefits get passed on to you. The biggest, most life-changing benefit is the 0% down payment requirement. You do not need a down payment. Period. Let me repeat that because it's the whole reason you're here. You can finance 100% of the home's purchase price. For a $300,000 home, that's $30,000 you don't need to have saved in a bank account. For a $400,000 home, that's $40,000. This single feature catapults people from being permanent renters to proud homeowners years, sometimes a decade, ahead of schedule. But the benefits don't stop there. Because the loan is government-backed, the interest rates are often some of the most competitive on the market. Frequently, you'll find that a USDA loan has a lower interest rate than a conventional loan for a borrower with the exact same credit profile. Over 30 years, that fraction of a percentage point can save you tens of thousands of dollars. Now let's talk about closing costs. These are the pesky fees for things like appraisals, title insurance, and loan origination that can add up to 2 to 5% of the purchase price. On that $300,000 home, you could be looking at another $6,000 to $15,000 you need to bring to the table. It's the gotcha moment for so many first-time buyers. But the USDA loan has a secret weapon here, too. If the home appraises for more than the purchase price, the USDA program allows you to roll your closing costs into the loan amount. Let's imagine you agree to buy a home for $300,000. You get it appraised, and the appraiser says it's actually worth $310,000. With a USDA loan, you can borrow the full $310,000, use $300,000 to pay the seller, and use the extra $10,000 to cover all of your closing costs. You just walked into a home with a mortgage, a deed in your name, and not a single dollar out of your own pocket. It is the closest thing to a true zero out-of-pocket home purchase that exists. Okay, this all sounds way too good to be true. A zero-down, low-interest loan where you might not even have to pay closing costs? There has to be a catch. And you're right, there are a few. But they're not catches so much as they are clear, understandable requirements. And for millions of Americans, they are not deal breakers. The first and most obvious requirement is location. The property you're buying must be located in a USDA-eligible area. There's no way around this one. You can't use this loan to buy a condo in downtown Manhattan or a bungalow in the heart of Los Angeles. But as we've already discussed, the eligible area is probably 10 times larger than you think it is. It's designed to support suburban and semi-suburban life, not just remote, rural living. The second major requirement is income limits. This program is designed for low to moderate income households. But again, moderate income is likely much higher than you think. The USDA sets the limit at 115% of the median household income for that specific area. In a higher cost of living suburb, the median income is also higher, which means the income limit for the loan is higher, too. For a family of 4, these limits can often exceed $100,000, sometimes significantly more depending on the county. It's not a program exclusively for the poor. It's a program for the middle class. It's for the teacher, the firefighter, the nurse, the family that makes a good living but hasn't had the chance to save up a massive down payment. The third requirement is credit. While the USDA itself doesn't set a minimum credit score, the private lenders who actually issue the loans do. Most lenders will look for a FICO score of 640 or higher to get approved through their automated underwriting systems. Is this a high bar? Not at all. A 640 score is considered fair credit and is well within reach for the average American. It's far more forgiving than the scores often required for the best terms on conventional loans. Finally, like the VA loan, there is a form of mortgage insurance. The USDA calls it a guarantee fee. It consists of 2 parts: an upfront fee that's rolled into the loan amount, and a small annual fee that's paid monthly with your mortgage payment. But here's the key. The USDA guarantee fee is almost always significantly cheaper than the private mortgage insurance, or PMI, you'd have to pay on a conventional loan with a low down payment. It's another built-in savings. So let's put it all together. Imagine a young couple. They both have decent jobs, a combined income of $95,000 a year, and credit scores around 680. They've been trying to save, but rent and car payments make it impossible to build a big nest egg. They want to buy a $350,000 home in a nice suburb about an hour outside their city, but the $70,000 down payment for a conventional loan feels like Mount Everest. They feel hopeless. Then they watch a video like this one. On a whim, they check the USDA eligibility map and discover that the exact suburb they've been dreaming of, the one with the good school district and the park for their future kids, is entirely within the eligible zone. They check the income limits for that county and find the maximum is $112,000. They're comfortably under it. Their 680 credit score is more than enough to qualify. Suddenly, the impossible becomes possible. They find a lender who specializes in USDA loans, get pre-approved, and a few months later, they're unlocking the front door to their very own home, having paid next to nothing out of pocket. This isn't a fantasy. This exact scenario plays out for tens of thousands of American families every single year. The USDA loan is arguably the most powerful, yet most misunderstood, home buying tool in the United States. It is a direct pathway to homeownership for middle-class Americans who play by the rules but can't seem to get ahead in the traditional system. But what if you don't qualify? What if you're not a veteran, and the home you want to buy is in a major city that is definitely not on the USDA map? Is the dream of buying with no money down over for you? Not even close, because there's an entire universe of programs designed specifically for you. They're called down payment assistance programs, and they can effectively erase your down payment and even your closing costs. And the best part? Many of them are not loans at all. They're grants, free money that you never have to pay back. And we're going to break down exactly how to find them next. So let's pull back the curtain on these programs. Think of down payment assistance, or DPA, as a layered treasure map. There isn't just one giant chest of gold. There are hundreds, even thousands of smaller troves hidden all across the country, sponsored at the federal, state, county, and even city level. Your job is to find the ones that have your name on them. Let's start at the top, the federal level. The U.S. Department of Housing and Urban Development, or HUD, is the big player here. Now, a common misconception is that you can just go to the HUD website and apply for a grant. Doesn't quite work like that. HUD is more like the central bank. They don't hand out cash to individuals directly. Instead, they fund state and local housing agencies, empowering them to create and manage their own specific programs. So while the money might originate from a federal initiative like the Home Investment Partnerships Program or a Community Development Block Grant, you'll be accessing it through a local gatekeeper. Think of HUD as the source of the river, but you'll be getting your water from a stream in your own backyard. This is where it gets really powerful. The real magic happens at the state level. Every single state in the US has what's called a Housing Finance Agency, or HFA. This should be your absolute first stop. Just go to Google and type in your state's name followed by Housing Finance Agency. This is the organization tasked with making housing more affordable for the residents of your state, and they are the primary distributors of down payment and closing cost assistance. Let's take an example. In California, you have CalHFA. They offer multiple programs, one of which is called the My Home Assistance Program. This program gives eligible first-time homebuyers a loan for up to 3.5% of the purchase price to cover their down payment and closing costs. Now, you might hear the word loan and think, wait, I thought we were talking about free money. This is a critical distinction you need to understand. DPA comes in a few different flavors. First, you have the pure grant. This is exactly what it sounds like, a gift. Money you are given that never ever has to be repaid. These are the golden ticket, and they absolutely exist. Second, you have what's called a forgivable loan. This is probably the most common type of assistance. A state or local agency will give you, say, $10,000 for your down payment. It's technically a loan with a 0% interest rate, but there's a string attached, a good one. They will forgive the loan over a set period, usually 5 to 10 years, as long as you continue to live in the home as your primary residence. For every year you live there, a portion of the loan is forgiven. If you stay for the full term, the entire amount disappears. Poof! It becomes a grant. You were rewarded for putting down roots in the community. Third, you have deferred payment loans. This is like an interest-free loan from a family member. You get the money now to close on your house, you pay 0 interest on it, and you don't have to make any monthly payments. You only pay it back when you sell the home, refinance, or pay off your primary mortgage, usually decades down the road. So while it's not free forever, it's free money now when you need it most, allowing you to get into a home and start building equity. So back to our treasure map. We've looked at the federal and state levels. But the search doesn't stop there. This is the part most people miss, and it's where you can find some of the most generous and specific programs. The county and city level. These hyperlocal programs are often designed to achieve very specific community goals. Maybe your city wants to encourage more teachers, nurses, firefighters, or police officers to live in the community they serve. So they'll create a targeted DPA grant specifically for those professions. Maybe there's a particular neighborhood the city wants to revitalize. They might offer $10,000 or even $20,000 in assistance to anyone willing to buy a home in that specific area. These are the hidden gems. How do you find them? You start digging. You go to your city's official government website and search for housing, community development, or down payment assistance. You do the same for your county's website. You'd be absolutely shocked at what you might find. I'm talking about programs that very few people even know exist, which means less competition for the available funds. Okay, this all sounds great, but it also sounds like a lot of work. How can you streamline this process? I'm going to give you a 4-step action plan. Step 1 is the HUD website. Even though they don't give you money directly, their website is an incredible resource. They have a state-by-state list of housing resources that will point you directly to your state's housing finance agency and other local counseling agencies. Step 2, as we mentioned, is to go directly to your state's housing finance agency website. This is non-negotiable. They will have the most comprehensive list of statewide programs, income limits, and approved lenders. Step 3 is a secret weapon. There's a website called Down Payment Resource. It's a nationwide database of homeownership programs. You can plug in your location, your profession, your income, and it will cross-reference that information with a massive database of DPA programs and spit out a list of ones you might be eligible for. It's an incredible shortcut that does a lot of the initial legwork for you. And step 4, which might be the most important of all, talk to a great local mortgage lender. And I don't mean just any lender from a big national bank. I mean a local loan officer or mortgage broker who lives and breathes your specific housing market. The best lenders know these DPA programs inside and out. They know which ones are easy to work with, which ones have funding available right now, and how to properly structure your application to get approved. They are your guide through this process. A bad lender won't even mention these programs because they can be more paperwork. A great lender will see them as the key to getting you into a home. Now, before you get too excited, we need to talk about the fine print. This isn't just a free-for-all. These programs have rules and eligibility requirements, and they generally fall into 4 categories. First, income limits. These programs are designed to help low to moderate income households. So, you can't be earning $500,000 a year and expect to get a grant. The limits are almost always based on the area median income, or AMI, of your specific county. So, the income limit in rural Wyoming will be very different from the limit in San Francisco. You typically need to be at or below 80% to 120% of the AMI to qualify. Second, you often need to be a first-time homebuyer. But, and this is a huge but, the definition of a first-time homebuyer, for most of these programs, is someone who has not owned a primary residence in the last 3 years. So if you owned a home, sold it 4 years ago, and have been renting ever since, congratulations, you are officially a first-time homebuyer again. Third, there are purchase price limits. Just like the income limits, the government isn't going to help you buy a multi-million-dollar mansion. The programs will have a maximum home price that you can't exceed, which again, is tied to the median home prices in your local area. And fourth, you'll almost always be required to complete a homebuyer education course. Don't roll your eyes at this. These are incredibly valuable courses, often available online for free or a very low cost, that teach you the A to Z of homeownership, from budgeting to maintenance. They are literally paying you to become a smarter, more prepared homeowner. It is an absolute win-win. So imagine a nurse named Sarah. She has a good stable job but has been struggling to save up the $20,000 or $30,000 needed for a down payment in her city. She feels stuck. But then she discovers her state's housing finance agency has a special program for healthcare workers that offers a $5,000 forgivable loan. Then, she digs deeper and finds out her specific city has a neighborhood revitalization grant for $10,000 if she buys in a certain area. By combining these two programs, she gets $15,000. That covers her entire 3.5% down payment on an FHA loan and a big chunk of her closing costs. Sarah goes from being a renter to a homeowner, with almost no money out of her own pocket. This story is not a fantasy. It happens every single day all across America. The money is out there. It's waiting for people who are willing to do a little bit of research. But these DPA programs aren't the only way to get to that zero-down finish line. There's another path, a powerful and often overlooked type of mortgage that comes with its own built-in 100% financing option, available to millions of Americans. And it has nothing to do with your profession or your income. It has to do with your location. We're talking about a loan program backed by the United States Department of Agriculture. Now hold on. Before you click away thinking, I'm not a farmer, I don't want to live in the middle of a cornfield, I need you to listen very carefully, because the name is the single most misleading thing about this entire program. This isn't about farming. It's about development. It's the USDA Rural Development Guaranteed Housing Loan Program, and it is, without a doubt, one of the most powerful and misunderstood keys to homeownership in America. The word rural conjures images of dirt roads, vast open spaces, and a town with one stoplight. And yes, those areas qualify. But the USDA's definition of rural is incredibly broad. It's a definition that was written decades ago and hasn't fully kept up with suburban sprawl. And that, right there, is the loophole. That is the opportunity. The USDA essentially defines rural as anywhere that is not a major metropolitan center. We're talking about huge swaths of the country. We're talking about charming small towns with vibrant main streets, just a 30-minute commute from a major city. We're talking about sprawling suburban neighborhoods with great school districts, community pools, and cul-de-sacs filled with kids riding bikes. Millions of Americans already live in USDA-eligible areas and have absolutely no idea. They think they're in the suburbs, and they are. But on the official map that matters, the one that unlocks 100% financing, their home is in a rural zone. Think about it. That growing town just outside the county line? Probably eligible. That new housing development that feels a world away from the downtown hustle, but is only a 25-minute drive? Almost certainly eligible. This program is designed to encourage growth and development in communities outside of the most densely packed urban cores. It's a government incentive saying, hey, instead of fighting for an overpriced condo downtown, why not build a life in this wonderful community just down the road? And to help you do that, we'll guarantee a loan for you so you don't need a down payment. So, how do you find out if the area you're dreaming of is on this magic map? The USDA has an eligibility map on their website. You can type in any address in the United States, and it will tell you, instantly, eligible or ineligible. It's that simple. It's a treasure map where X marks the spot for a zero-down mortgage. You can spend hours exploring, zooming in on the outskirts of your target city, and you will be shocked at what you find. You'll see the ineligible city core shaded in, but just beyond it, vast territories of opportunity open up, painted in the color of eligibility. That beautiful town you thought was out of reach might be sitting right in the sweet spot. Okay, so you've found an eligible area. That's step one. What's the catch? There are two other major requirements, and they're just as misunderstood as the location rule. The first is income. This program is not for the wealthy. It's specifically designed to help low to moderate income households. But again, just like the word rural, the term moderate income is probably a lot more than you think. The income limits vary by county and by household size, because the cost of living is different everywhere. In a lower cost area, the limit for a family of 4 might be around $90,000 a year. But in a higher cost suburban county outside a major city, that limit could be well over $150,000. It's not uncommon to see limits exceeding $200,000 in pricier parts of the country. This isn't a program for minimum wage earners. It's a program for the backbone of the American economy. It's for teachers, firefighters, nurses, mechanics, office managers, and skilled trade workers. It's for dual-income families who make a good living, but have been crushed by student loan debt and soaring rents that make saving for a 20% down payment feel like trying to fill a bucket with a hole in it. The government has a tool for this too. You can go online, select your state and county, enter your household size and income, and it will tell you if you qualify. No guessing required. So you've got an eligible property and you're under the income limit. What else? You still need to qualify based on your credit, just like any other loan. Most lenders who offer USDA loans are looking for a credit score of 640 or higher. This is pretty standard. They'll verify your employment, look at your debt-to-income ratio, and make sure you have a stable history of paying your bills. This is not a subprime loan. It's a prime loan for qualified borrowers that just happens to come with an incredible benefit. The property itself also has to meet certain minimum standards. It has to be safe, sound, and sanitary. But these are the same basic standards you'd want in any home you buy. Now for the part everyone asks about. If there's no down payment, how does the lender protect themselves? With conventional loans, you have PMI private mortgage insurance. With USDA loans, you have something similar, but it works a little differently and is often cheaper. It's called a guarantee fee. It's broken into two parts. First, there's an upfront guarantee fee. As of right now, it's about 1% of the loan amount. So on a $300,000 loan, that's $3,000. But here is the beautiful part. You do not have to pay this out of pocket. This fee can be rolled right into your total mortgage amount. So your $300,000 home purchase becomes a $303,000 loan. You still show up to closing with $0 down. This is fundamentally different from many other loans where mortgage insurance is a separate, out-of-pocket monthly cost. Second, there is an annual fee, which is broken up and paid monthly in your mortgage payment. This fee is currently 0.35% of the loan balance. Let's put that in perspective. On that same $300,000 loan, that's about $87 a month. Compare that to PMI on a conventional loan with low money down, which could easily be $150, $200, or even more per month. An FHA mortgage insurance is significantly higher and often lasts for the entire life of the loan. The USDA fee is not only lower, but it also decreases every year as you pay down your loan balance. So let's put it all together. The USDA loan offers 100% financing. You can literally buy a home with no money down. The seller can even pay your closing costs, meaning you could get into a house for next to nothing out of pocket. The interest rates are highly competitive, often on par with or even better than conventional loans, because the government guarantee reduces the risk for the lender. And the mortgage insurance, the guarantee fee, is typically more affordable than the alternatives. This is a game changer. This is the path that allows a young couple, who thought they were 5 years away from saving a down payment, to buy a home this year in a beautiful suburb with a great school district. It's the tool that lets someone escape the endless cycle of renting and start building equity and a future for their family. It's not a myth. It's not a gimmick. It's a real tangible program. But knowing about the VA loan or the USDA loan, or any of these zero-down options is only half the battle. You can find the perfect house in a USDA-eligible zone, meet the income requirements and have a great credit score, but then you hit a wall. You walk into your local big bank, the one on every corner, and you ask for a USDA loan, and the loan officer just gives you a blank stare. The surprising truth is, The people who hold the keys to these incredible loans aren't always easy to find. Not every lender is approved to offer them, and even among those who are, many don't specialize in them. So how do you find the experts? How do you connect with the right lender who lives and breathes these programs and can guide you through the process, instead of one who sees it as a confusing side product? That's the critical next step, and it's exactly where we're headed next. Finding the right lender is like finding the right key for a very specific, very important lock. You can have a whole keychain of keys, but if none of them are cut for that particular lock, you're not getting in the door. And in the world of zero-down mortgages, most lenders are holding the wrong keys. They're generalists. They're great at the standard 20% down conventional loan. That's their bread and butter. But when you walk in and say the words USDA loan or down payment assistance grant, their eyes might glaze over. They see paperwork, complexity, and a smaller commission. Let me tell you a quick story about a couple we'll call Mark and Sarah. They were classic first-time homebuyers. Good jobs, responsible with their money, but living in a high cost of living area. Saving up a massive 20% down payment felt like trying to fill a bucket with a hole in it. Every time they saved $1,000, home prices seemed to jump by $5,000. They heard about the VA loan. Mark was a veteran, and they were filled with hope. This was it. This was their key. So they did what most people do. They walked into the giant name-brand bank on the corner where they'd had their checking accounts since college. They trusted the name. They sat down with a loan officer who was perfectly pleasant, offered them coffee, and listened to their story. When Mark mentioned the VA loan, the loan officer smiled, but it was a tight smile. He said, "Yeah, we can look at that, but honestly, they're a real headache. The appraisals are tough, the government underwriting takes forever, and sellers don't like them. A low down payment conventional loan is much cleaner. We can probably get you in with 5% down." Mark and Sarah left that meeting feeling completely deflated. The one path that seemed so promising was now presented as a minefield. That 5% down was still over $20,000 they didn't have. They felt like failures, like homeownership just wasn't in the cards for them. The expert at the big, shiny bank had basically told them their key was broken. What they didn't realize is that they hadn't talked to an expert. They had talked to a salesperson who didn't know how to use their key, so he tried to sell them a different one he was more comfortable with. This happens every single day across the country. So how do you avoid this? You have to become a savvy shopper, not for a house, but for your financial partner. You need to find a specialist. Think of it like this: if you have a common cold, you go to your family doctor. But if you have a complex heart issue, you don't ask your family doctor to perform surgery. You seek out a cardiologist, a specialist who has dedicated their career to understanding that one specific complex system. Zero down and government-backed loans are the cardiology of the mortgage world. And the specialists are not always in the most obvious places. So where do you find them? Your first stop should be an independent mortgage broker. A mortgage broker is the ultimate free agent. They don't work for one specific bank. Instead, they have relationships with dozens, sometimes hundreds of different lenders, from the giant national players to small, niche credit unions and private lenders you've never even heard of. Their entire job is to be your personal loan shopper. You tell them your story, your financial situation, and your goals, and they go to their network to find the lender and the program that is the absolute best fit for you. They know which lenders love VA loans, which ones are experts in the USDA process, and which ones are deeply connected with local down payment assistance programs. A good broker is a matchmaker, and they can be your single greatest asset. Your second stop: local credit unions. Credit unions operate on a different philosophy than big banks. They are nonprofit institutions owned by their members. Their primary mission isn't to generate massive profits for shareholders. It's to serve their members and their community. Because of this, they are often champions of programs designed to help people get into homes. They're frequently more flexible, more patient, and their loan officers are often deeply knowledgeable about state and local first-time homebuyer grants and programs that a big national bank wouldn't even know exist. Don't underestimate the power of a local player who is invested in your community's success. Third, you can look for direct lenders who specialize. Some mortgage companies have built their entire reputation on being the best at one thing. There are lenders who are famous in the industry for being VA loan powerhouses. They close thousands of them a year. Their entire staff, from the loan officers to the underwriters to the processors, is trained specifically on the nuances of that one loan type. They see the so-called red tape not as a hurdle, but as a simple checklist they complete every single day. You can find them by looking at how they advertise. Do their websites and ads scream VA loan experts? Do their reviews constantly mention how they helped veterans when no one else could? That's your sign. Once you have a list of potential lenders, brokers, credit unions, specialists, you need to interview them. Yes, you are the one in charge here. You are the customer. You are the CEO of your home purchase. And you need to conduct an interview to see who is worthy of being on your team. And I'm going to give you the exact questions to ask. Don't just ask, can you do a zero-down loan? Ask these instead. Question 1. How many VA loans or USDA loans or loans using down payment assistance did you personally close in the last 12 months? A specialist will know this number off the top of their head and will be proud of it. If they say, oh, a few here and there, or let me check on that, that's a red flag. You're looking for someone who says, we closed 42 VA loans last quarter alone. It's about half of what I do. That's a specialist. Question 2. What is the most common problem you encounter with these loans? And what is your specific strategy for solving it? This question separates the pros from the amateurs. A generalist will give you a vague answer about government red tape. A specialist will say, with VA appraisals, the biggest issue can be the minimum property requirements. So what I do is have a detailed conversation with the buyer's real estate agent before you even make an offer to make sure we're all looking for the right things. And I have a list of appraisers who are experienced and fair. That is an answer based on real-world experience. Question 3. Can you connect me with a real estate agent you've worked with who is also an expert in these types of transactions? This is the killer question. An experienced lender will have a network of all-star real estate agents who understand the specific needs of VA and USDA buyers. They know which properties will qualify, how to write an offer that a seller will accept, and how to navigate the process smoothly. If the lender can't immediately recommend an agent they trust, it means they don't do enough of these loans to have built those critical relationships. Let's go back to Mark and Sarah. After their crushing defeat at the big bank, a military buddy of Mark's told them to call a specific mortgage broker he had used. He said, "This guy only works with vets." They were skeptical, but they made the call. The difference was staggering. The broker didn't start by talking about obstacles. He started by thanking Mark for his service. He didn't push them toward a different loan. He celebrated the fact that Mark had earned this incredible benefit. He answered their questions before they even asked them. He explained the VA appraisal process, not as a hurdle, but as a protection for them, ensuring they were buying a safe, sound home. He laid out a clear step-by-step plan. Within a 30-minute phone call, Mark and Sarah went from hopeless to empowered. Their dream was alive again. That broker connected them with a real estate agent who specialized in working with veterans, and 2 months later, they closed on their first home. 0 down. The lender you choose is arguably more important than the house you choose. Because the right lender opens the door to all the houses. The wrong lender closes them all. Your mission is not just to find a loan. It's to find a guide, a partner, a specialist who knows the path because they walk it every single day. But finding that specialist and getting pre-approved is only half the battle. Now you have to find a house that qualifies. Because here's a critical truth many people don't realize. The property itself has to get approved too. Government-backed loans have specific requirements for the condition and location of the home. And if you fall in love with a property that doesn't meet them, your zero-down dream can turn into a nightmare. Understanding these property requirements is the next crucial piece of the puzzle. And it's what will keep you from wasting time and getting your heart broken. So let's talk about these property requirements, because they are the gatekeepers of your zero-down loan. It's not just about the government or the lender being picky for the sake of it. Think of these rules as a built-in protection plan. When you're putting $0 down, the lender is taking on 100% of the financial risk. So they, along with the VA or USDA, need to be absolutely certain that the house they're backing is a solid, safe, and secure investment. More importantly, they're protecting you, the buyer, from stepping into a financial landmine disguised as a house. Let's start with the VA loan, which has a very specific set of guidelines known as minimum property requirements, or MPRs. Don't let the acronym scare you. At their core, MPRs are a simple checklist to ensure the home is safe, structurally sound, and sanitary. This isn't about whether the kitchen has granite countertops or if the bathroom tile is outdated. This is about the fundamental health of the home. First up, safety. The VA wants to know that you and your family will be safe living there. This means things like no exposed electrical wiring, functional and secure handrails on all staircases, and no evidence of lead-based paint hazards in homes built before 1978. An appraiser might walk in and see a beautiful 3-story home, But if the staircase to the second floor is missing a handrail, that's an automatic red flag. It's a safety issue. The furnace must be in good working order, and there has to be a safe and reliable source of heat. They're looking for anything that could pose an immediate risk. Next is structural soundness. This is the big one. The home needs to have good bones. The VA appraiser will be looking at the foundation for any major cracks or signs of settling. They'll look at the roof to make sure it's in good condition and has at least a few years of life left in it. No active leaks allowed. They'll check for evidence of termite damage, dry rot, or any other pest infestations that could compromise the structure of the house. A home with a crumbling foundation or a roof that needs to be completely replaced tomorrow is not what the VA considers a sound investment. It's a money pit waiting to happen, and that's exactly what NPRs are designed to prevent you from buying. Finally, there's the sanitary requirement. This is about basic livability. The property must have a continuous supply of safe drinking water. It needs an adequate and sanitary sewage disposal system, whether that's a connection to a public sewer or a properly functioning septic tank. The home has to be free from moisture and dampness issues that could lead to mold. It needs proper ventilation, especially in crawl spaces and attics, to prevent moisture buildup. Essentially, does the house provide a healthy living environment? Now, who decides if a property meets all these NPRs? This is the crucial role of the VA certified appraiser. Unlike a conventional loan where the appraiser's main job is just to determine the home's market value, the VA appraiser wears two hats. Yes, they determine the value, but they are also the VA's on-site inspector, meticulously checking the property against that NPR checklist. They are your first line of defense. So what happens if the appraiser finds an issue? Let's say they note that the roof is leaking or there's a broken window. This doesn't automatically kill the deal. The appraisal report will come back subject to repairs. This means the loan can only proceed once those specific issues are fixed and verified. Now you have a few options. The best case scenario is that the seller agrees to pay for and complete the repairs before closing. In some cases, a buyer might consider paying for them, but this is a risky move on a house you don't yet own. The third option is that the seller refuses and you have to walk away from the deal. And while that stings, remember the purpose. The NPRs just saved you from buying a house with a leaky roof that you would have been responsible for fixing on day one. This is also why it's nearly impossible to buy a true fixer-upper with a VA loan. The program is designed for move-in-ready homes that are safe and sound from the get-go. Now let's shift gears to the USDA loan. The philosophy here is very similar. The government wants to ensure it's backing a solid property, but the USDA has its own unique flavor of requirements. First, as we've discussed, the property must be in an eligible rural area. But beyond that, the property itself has to meet certain standards. The biggest one is that the home must be modest in size, design, and cost for the area. This is a bit subjective, but the spirit of the rule is clear. The USDA loan program is designed to help low to moderate income families, not to finance luxury estates. So a 6,000 square foot mansion with an in-ground pool, a tennis court, and a market value double the average for that town is not going to qualify, even if it's in a technically eligible rural zone. The property's value can't be so high that it's clearly a luxury property. Like the VA loan, the property must be the borrower's primary residence. You can't use a USDA loan to buy a vacation home or a rental property. The program also has restrictions against properties that are designed for income production. So, a massive farm with extensive commercial operations wouldn't qualify, but a modest home on a few acres where you might have a small garden is perfectly fine. When it comes to the physical condition of the house, the USDA standards are very similar to FHA and VA guidelines. The mantra is once again, safe, sanitary, and structurally sound. They'll look for a solid foundation, a roof in good condition, and up-to-date electrical and plumbing systems. The heating and cooling must be adequate and functional. A private well or septic system must be in good working order and meet local health department standards. The USDA appraisal process also mirrors the VA's. The appraiser will assess the home's value and its condition. If they find issues, peeling paint, a faulty water heater, a soft spot on the floor, those will need to be repaired before the loan can close. Again, the seller is typically expected to handle these repairs. So what's the big takeaway from all of this? For both VA and USDA loans, the condition of the property is non-negotiable. You can have a perfect credit score, a great income, and find a house in the perfect location. But if that house has a bad roof or a cracked foundation, the deal is dead in the water. This leads to an incredibly important piece of practical advice. Before you even make an offer, you need to start thinking like an appraiser. When you're touring a home, don't just get swept up by the new kitchen or the big backyard. Look closer. Look for the potential red flags. Are there water stains on the ceiling? Does the floor feel spongy when you walk on it? From the street, can you see curled or missing shingles on the roof? Jiggle the handrails. Look under sinks for signs of leaks. Doing this little pre-inspection for yourself can save you hundreds of dollars on an appraisal fee for a property that has no chance of passing. It also helps you focus your search on homes that are more likely to qualify, saving you immense time and heartache. You need to find a home that is both your dream and a sound investment in the eyes of the VA or USDA. Knowing what to look for in a property is half the battle. The other half is having the right team of professionals in your corner who understand these nuances inside and out. Because an agent or a lender who has never navigated an NPR list or dealt with the subject to appraisal can be just as detrimental to your home buying journey as a leaky basement. And finding that expert team is the next critical step we need to cover. So, how do you find these experts? This isn't about a Google search for real estate agent near me. This is about a deliberate strategic interview process. You are the CEO of your home purchase and you are hiring your executive team. Let's start with the most critical hire. Your loan officer. The biggest mistake homebuyers make is walking into their primary bank, the one where they have their checking account, and assuming that's the best place to get a mortgage. For a zero-down loan, this can be a fatal error. Think of it this way: your family doctor is great for a checkup, but if you need heart surgery, you're going to a cardiologist, a specialist. Most big banks and generic online lenders are family doctors. They can handle a conventional loan with 20% down in their sleep. But the intricate government-regulated worlds of VA and USDA loans? That's heart surgery. They might technically offer the product, but they don't live and breathe it. Their underwriters see one of these loans once a month, not 10 times a day. This lack of repetition, this lack of specialization, is where delays, miscommunications, and deal-killing mistakes are born. You need a specialist. Your first question to any potential lender should not be, "What's your interest rate?" Rates are important, but a great rate doesn't matter if you can't close the deal. Your first question must be, how many VA loans or USDA loans have you personally closed in the last 12 months? Listen carefully to the answer. If they hesitate, if they say, "Oh, we do a bunch of them," or if they give you a vague company-wide number, that's a yellow flag. You want their personal number. If that number is less than a dozen, you are talking to a generalist. Thank them for their time and move on. A true specialist will close dozens, if not hundreds, of these specific loans every single year. They'll be proud of it and will tell you the exact number without blinking. But don't stop there. Here's your interview script. Question 2. What are the most common underwriting hurdles you see with this specific loan type? And what is your strategy for proactively addressing them before they become a problem? A specialist will immediately start talking about things like residual income calculations for VA loans, or property eligibility maps and income limits for USDA loans. They'll tell you how they gather extra documentation up front to satisfy the underwriter, or how they structure the file from day one to sale through the system. A generalist will say, "Oh, we just submit the paperwork and see what they ask for." That's a reactive approach, and in the world of mortgages, reactive means delayed, stressed, and potentially denied. Question 3, and this is the big one. Walk me through your process when an appraisal comes back with required repairs. This is the moment of truth. This question directly tests their experience with the minimum property requirements we just talked about. A specialist will have a battle-tested plan. They'll say something like, "The second the appraisal comes in, my team and I review it for any NPR issues. If there are, I immediately call you and your agent to strategize. We'll discuss the options. Negotiating with the seller to complete the repairs, arranging for an escrow holdback if the lender allows it, or determining if the repairs are deal breakers. We have this conversation within hours, not days." A generalist might say, "Well, the appraiser sends a list and I guess you have to get them fixed." That lack of a clear, immediate action plan is how deals die on the vine. Now, where do you find these specialists? Start by asking for referrals from real estate agents who also specialize in these loans. Look for mortgage brokers, not just direct lenders. A good broker has relationships with multiple wholesale lenders, some of whom might be niche specialists in government loans. Also, consider credit unions, especially those with a military affiliation like Navy Federal, if you're a veteran seeking a VA loan. They are built from the ground up to serve that community and understand the product inside and out. Once you've secured your specialist lender and have that rock-solid pre-approval in hand, it's time to hire your second key team member, your real estate agent. And the same rules apply. Using a friend of a friend who just got their license is not an option. You need another specialist. The agent's role goes far beyond just showing you houses. With a zero-down loan, they are your negotiator, your strategist, and your frontline defense against property issues. Your interview process for an agent should be just as rigorous. Start with the same opening question. How many buyers have you successfully helped close using a VA or USDA loan in the last year? Again, you're looking for experience and volume. An agent who has closed 10 of these deals is going to know how to navigate the process far better than an agent who has only closed one. Next question. How do you frame an offer with a zero-down loan to make it competitive, especially against cash or conventional offers? This tests their strategic mind. A novice agent might just submit the offer and hope for the best. A seasoned pro will tell you about their communication strategy. They'll say, "Before I even submit your offer, I call the listing agent. I introduce myself, I talk about my experience with VA or USDA loans, and I explain that my lender is a specialist who we know can close on time. I sell us as a team. I work to dispel any myths the seller might have about these loans being slow or difficult. I build confidence from the very first conversation." That proactive communication can be the single factor that gets your offer accepted over another. And finally, the knockout question for an agent. How familiar are you with the minimum property requirements, and how do you help clients identify potential issues during a showing? A great agent acts as your first line of defense. They should be able to walk into a home with you and gently point out potential red flags. They'll say things like, "See that peeling paint on the exterior? That will likely get called out by a VA appraiser." Or, "The handrail is missing on this staircase. That's a safety issue that will need to be fixed." Or, "This home is fantastic, but I checked the USDA property eligibility map, and it's just outside the approved zone." This knowledge is priceless. It saves you from falling in love with a house that has no chance of passing the appraisal, saving you the time, the emotional roller coaster, and the cost of an inspection and appraisal on a doomed property. An agent who isn't familiar with MPRs is flying blind, and they're taking you along for the ride. The red flags to watch for are almost the inverse of these good answers. An agent who tells you, "Don't worry, all loans are basically the same," or who tries to steer you away from using your VA or USDA benefit because it's more work, is not the agent for you. They are prioritizing their own convenience over your financial well-being. Your zero-down loan is not an inconvenience. It is a powerful advantage, and you need an agent who sees it that way. Ultimately, your lender and your agent must function as a single cohesive unit. They should communicate with each other constantly, without you having to play mediator. A great agent will have a short list of lenders they trust, and a great lender will have a list of agents they know can get the job done. When you find one, ask for a referral to the other. When you have a team that has worked together before, that understands the specific challenges and choreography of a zero-down purchase, the entire process transforms. It goes from being stressful and uncertain to smooth and predictable. You are not just looking for a loan officer and a real estate agent. You are assembling your personal special ops team for one of the biggest financial missions of your life. Their expertise is not a luxury. It's the foundation upon which your entire homeownership dream will be built. Choosing them wisely is the single most important decision you will make, long before you ever step foot in a potential home. And once that team is in place, you're finally ready to enter the battlefield and start making offers. This is the moment of truth. You've done the hard work. You've conquered your credit, you've secured your pre-approval, and you've assembled an elite team. Now you're standing at the edge of the real estate battlefield, and the offer you're about to write is the first shot you're going to fire. How you craft this offer, especially as a zero-down buyer, can be the difference between getting the keys to your dream home and starting the soul-crushing search all over again. First, let's talk about your primary weapon, that pre-approval letter. I cannot overstate this. For a buyer using a VA, USDA, or down payment assistance program, your pre-approval letter isn't just a piece of paper. It's a statement of power. A weak, quickly generated pre-qualification is worthless. You need a full-blown, rock-solid pre-approval where the lender has verified your income, your assets, and your credit. Why? Because a seller and their agent are going to scrutinize your offer. They might see zero down and immediately think higher risk. Your pre-approval letter is your proof that you are not a risk. You are a serious, qualified buyer backed by a diligent lender. An even more powerful version is a TBD, or to be determined approval, where an underwriter has already signed off on your entire financial profile before you've even found a property. It's the equivalent of showing up to a negotiation with a briefcase full of cash. It tells the seller that the only remaining variable is the house itself, dramatically reducing the chances of your financing falling through. Now, let's break down the offer document itself. It's more than just a price. It's a strategic package with multiple levers you can pull. The first and most obvious is the purchase price. This isn't a wild guess. Your agent will run a comparative market analysis, or CMA, looking at what similar homes in the neighborhood have recently sold for. This is your data, your intelligence report. Based on this, you decide on an offer price. Are you in a hot market where homes are getting multiple offers? You might need to offer at or even above the asking price. Is the house been sitting on the market for a while? You might have some room to negotiate down. But remember, as a zero-down buyer, you need to be especially careful about offering way over asking price. This brings us to the most critical, most dangerous, and most misunderstood part of any offer: contingencies. Contingencies are safety hatches. They are clauses that let you back out of the deal without losing your deposit if certain conditions aren't met. The three main ones are the inspection contingency, the appraisal contingency, and the financing contingency. In a hyper-competitive market, you'll hear about buyers waiving these to make their offers more attractive. For you as a zero-down buyer, this is playing with fire. Let me be blunt. You should almost never, ever waive your financing and appraisal contingencies. The financing contingency protects you if, for some reason, your loan gets denied at the last minute. It's your ultimate safety net. Waiving it means if the loan falls through, you could lose your deposit and even be sued by the seller. The appraisal contingency is just as vital. The bank will only lend you money based on the home's appraised value. Let's say you offer $400,000 for a house. If the appraiser comes back and says the house is only worth $390,000, you have an appraisal gap of $10,000. A buyer with cash reserves might be able to pay that $10,000 out of pocket to make the deal work. But as a zero-down buyer, you likely don't have an extra $10,000 just sitting around. The appraisal contingency allows you to renegotiate the price with the seller or walk away from the deal with your deposit intact. Without it, you'd be legally obligated to come up with that $10,000 or face serious financial and legal consequences. This is a trap you cannot afford to fall into. The inspection contingency is also crucial, but you have a little more flexibility here. It allows you to have a professional inspect the home, and then request repairs or credits from the seller, or back out if you find major issues like a cracked foundation or a failing roof. You can make this contingency more attractive to a seller by shortening the time frame, say, to 7 days instead of the standard 10 or 14. This shows you're serious and won't drag out the process. Next up is the earnest money deposit, or EMD. This is the good faith deposit you put down when your offer is accepted. It's held in a neutral account and is typically applied to your closing costs. The standard amount is often 1 to 3% of the purchase price. For a zero-down buyer, coming up with thousands of dollars for an EMD can be a challenge. But a low EMD can make your offer look weak. So what can you do? First, talk to your lender. Some down payment assistance programs can help cover the EMD. You can also get creative. You could offer a smaller initial deposit, say $1,000, with a promise to increase it to the full amount after the inspection contingency is cleared. This shows the seller you're serious, but gives you time to make sure the house is sound before putting more money on the line. Now let's think like the seller for a moment. They're looking at two offers. One is from a buyer putting 20% down. The other is your zero-down offer. On the surface, theirs looks safer. So how do you compete? You use every other tool at your disposal. Maybe you offer a slightly higher price. Maybe you offer a more flexible closing date that perfectly matches the seller's timeline. This can be incredibly valuable. If the sellers are building a new home and need to stay put for an extra 60 days, being the buyer who can accommodate that can be more important to them than an extra few $1,000s. Your team also goes on the offensive. This is where having a great lender and a savvy agent pays off. Your agent shouldn't just email your offer. They should call the listing agent. They should sell you. They'll say, "I'm sending over an offer from my clients. They're using a VA loan. They are incredibly well qualified, and I've personally spoken with their lender, who is fantastic and has already done a full underwritten approval. These buyers are solid, and they absolutely love your seller's home." At the same time, your loan officer should also call the listing agent. They'll say, I'm the lender for the buyers. I want to personally assure you that I have reviewed all of their financials, and they are rock solid. We are ready to close on time with no issues. This two-pronged professional assault can completely change the perception of your offer. It transforms you from a risky zero-down buyer into a committed, fully vetted homebuyer with a proactive professional team. Finally, what happens when they don't just accept? What if they send back a counteroffer? Don't panic. This is normal. A counteroffer isn't a rejection. It's an invitation to continue the conversation. They might ask for a higher price, a shorter contingency period, or a different closing date. This is where you lean on your agent. Analyze the counteroffer. Does it still work for your budget? Are the requests reasonable? You can accept it, reject it, or send back your own counteroffer. It's a negotiation, a dance. Stay calm, be strategic, and don't get so emotionally attached to the house that you make a bad financial decision. Crafting a winning offer with a zero-down loan isn't about having the most cash. It's about being the smartest, most prepared buyer in the room. It's about building a story of strength and reliability around your offer, using a bulletproof pre-approval, strategic terms, and a team that will fight for you. You present a clean, professional package that anticipates and addresses a seller's potential concerns before they even become issues. And then you wait. The waiting is the hardest part. But if you've done everything right, you'll get the call you've been dreaming of. The call that says your offer has been accepted. It's a moment of pure joy and excitement. But I want you to know that's not the finish line. That's the sound of a different starting gun. Because the moment your offer is accepted, a brand new clock starts ticking. The race to closing has just begun. The race to closing has just begun. This next 30 to 60 days is what separates the dreamers from the homeowners. It's a period filled with paperwork, anxious phone calls, and moments where you'll wonder if this is all going to fall apart. It's called being in escrow, and it's the final gauntlet you have to run. Your first major hurdle is the home inspection. This is where you hire a professional to go through the house with a fine-tooth comb. They're not looking for cosmetic stuff like ugly paint colors. They are looking for the monsters hiding in the walls. A cracked foundation, a leaky roof, faulty wiring, a furnace on its last legs. You'll get a report that's 50 pages long and looks terrifying. Every little issue is documented in triplicate with scary-looking photos. Your heart will sink. You'll think, oh my God, I'm buying a lemon. Take a deep breath. This is normal. No house is perfect, not even new construction. The goal here isn't to find a perfect house. It's to understand exactly what you are buying. The big-ticket items are what matter: the roof, the HVAC system, the foundation, the electrical, the plumbing. If one of these is a major problem, you have leverage. You go back to the seller and negotiate. You can ask them to fix it before closing. You can ask for a credit, which means they reduce the price or give you cash back at closing so you can fix it yourself. Or, if the problem is just too big, too expensive, this is your chance to walk away and get your earnest money back. The inspection is your single greatest protection in this entire process. Do not skip it. Do not cheap out on it. It's the shield that protects you from a catastrophic financial mistake. Once you've navigated the inspection, the next boss battle appears. The appraisal. This one is ordered by the lender. See, the bank is giving you a massive loan, and they need to make sure the asset they're loaning against, the house, is actually worth the money. So they send out a licensed appraiser to determine the home's fair market value. This is one of the most nerve-wracking moments of the entire journey. You just wait for days, and you pray. You pray the appraisal comes in at value. If you offered $400,000, you need that appraiser to say the house is worth at least $400,000. If it does, you breathe a huge sigh of relief and move on. But what if it doesn't? What if it comes in low? Let's say it appraises for $390,000. Now you have what's called an appraisal gap. The bank will only lend you money based on the appraised value, the $390,000. So you have a $10,000 shortfall. Again, you have options. You can try to challenge the appraisal, but that rarely works. You can go back to the seller and try to renegotiate the price down to the appraised value. In a hot market, they might just say no and move on to the next buyer. You can try to meet in the middle. Or, and this is the toughest pill to swallow, you can pay the difference in cash. For someone using a zero-down loan, coming up with an extra $10,000 in cash might be impossible. This is why having an agent who understands how to write protective clauses into your offer is so critical. An appraisal contingency allows you to walk away from the deal with your earnest money if the appraisal comes in low. It's another shield. Use it. While all of this is happening, your loan file is entering the final mysterious stage. Final underwriting. Your loan officer has packaged up all your documents, your pay stubs, your bank statements, your life story, and sent it to the underwriter. The underwriter is the final gatekeeper. They are the person in a quiet room somewhere who gives the final yes or no. Their only job is to protect the lender from risk. They will re-verify everything. They will re-pull your credit. They will recheck your employment. This is why you hear the golden rule of home buying. Once you are in escrow, do not make any major financial changes. Do not go finance a new car. Do not buy a living room full of furniture on credit. Do not quit your job to start a new business. Do not even deposit a large, random amount of cash into your bank account without a paper trail. The underwriter will see it, and they will demand to know where it came from. You need to become a financial ghost. Live frugally. Keep everything exactly as it was when you first applied. Any sudden change can look like a red flag and derail the entire loan at the 11th hour. It happens. Don't let it happen to you. Finally, after the inspection is cleared, the appraisal is good, and the underwriter gives that magical, beautiful, career-defining stamp of approval that says clear to close. You're almost there. You'll do one last walkthrough of the house, usually the day before or the morning of closing, just to make sure the home is in the same condition you agreed to buy it in, and that any negotiated repairs were actually done. And then comes the moment. The closing table. You'll walk into a title company office. There will be a stack of paper in front of you that looks like a phone book for a small city. The closing agent will walk you through it. You will sign your name, and sign it again, and again. Your hand will cramp. You'll initial here, you'll date there. You'll be signing documents that promise you'll pay this mortgage for the next 30 years. Feels heavy, feels monumental, because it is. You'll sign one last page. The closer will congratulate you, and then they'll slide a set of keys across the table. They're just little pieces of metal, but they're the heaviest, most beautiful things you've ever held. Those aren't just keys. They are the keys to your future. The key to a front door that is yours. The key to a bedroom where your kids will grow up. The key to a backyard where you'll have barbecues. The key to a garage where you might start a project. The key to building equity, to creating generational wealth, to putting down roots in a community. All of this from the first video you watched, from the first time you thought, maybe I could do this, was leading to that moment. Using a VA loan, a USDA loan, a NACA program, or a down payment assistance grant isn't a cheat code. It's not a loophole. It's a tool. It's a key designed for people who serve our country, who build our rural communities, who work hard every single day, and deserve a chance to own their own piece of America. The path isn't easy. You have to save. You have to fix your credit. You have to get educated. You have to be resilient when an offer gets rejected or an appraisal comes in low. But I want you to look at those keys on the table. That is why you do it. Homeownership is not about a building. It's about stability. It's about freedom. It's about knowing that no landlord can raise your rent or tell you that you can't paint a wall your favorite color. So if you're watching this right now, and you're in an apartment you hate, or living in your parents' basement, or just feeling like this dream is for everyone else but you, I want you to know that it is possible. The information is out there. The programs exist. The path is there if you're willing to walk it. Your homework isn't to go out and buy a house tomorrow. Your homework is to start. Check your credit score. Start a budget and see where you can save, even if it's just $20 a week. Find a local, highly rated loan officer and just have a conversation. Ask them, what would it take for me to get here? Let them give you a roadmap. You can do this. The journey is long, but the destination is worth every single step. Thank you for spending this time with me. Now go take that first step.